Hey everyone, it's Chris Hobart, the Wealthologist. Now I know there's been a lot of noise lately. There's stock markets dip, tariff chaos, even constitutional drama. And now the GDP just dropped. So the question is, are we in a recession? Let's talk about it on this week's Wealthologist Weekly. All right, folks, let's take a deep breath. There is a lot of fear flying around this week. Yes, real GDP declined at a 0.3% annual rate in the first quarter of 2025. That's the first quarterly drop since 2022. So, cue the headlines, right? Recession. But hold up, because the numbers don't really tell the full story. The biggest reason GDP slipped, well, it's trade. Imports spiked because businesses and consumers scrambled to bring in goods before new tariffs kicked in. We talked about this last week or the week before. Now, here's the thing: GDP measures domestic production. So when we import goods, it actually subtracts from our GDP. Even though we bought more stuff because it came from overseas, it begins to pull GDP down. So the question is, does that mean our economy is tanking? No. It just means we need to read GDP numbers the right way given the current economy. So let's zoom in on the actual engine of the economy, which is what we call core GDP. Now, we've talked about this before. That's consumer spending, that's business investment, and home building. Core GDP actually grew at a solid 3% annual rate last quarter. Now, that's the same as the average over the past year. Good news. That is not recession territory. In fact, it's steady. Now, look at this. Consumer spending, it's up 1.8%. Business investment in equipment, well, up a jaw-dropping 22.5%. Non-farm payrolls up 177,000 last month, averaging $144,000 per month this year. Now, what about industrial production? It's up 5.5% annualized, and manufacturing up 5.1% annualized. I got to tell you, the good news is these are not recession stats. They're what we would consider resilient stats. Now, here's something encouraging. Last year and the year before, most new jobs, it came from government-funded sectors. We've talked about this: healthcare, education, social services. Now we're seeing a shift in that mix. In the past 3 months, less than half of the new jobs are coming from those sectors. That means more of our job growth is now coming from the private economy, not just government spending. But I don't want you to get too comfortable, right? I know you were sitting there wiping your brow. Look, just like in early 2022, we're seeing GDP dip from one off factors like inventory and trade volatility, not broad economic weakness. But there's still real risk ahead. Now, why is that? Well, for starters, we're just now feeling the delayed impact of the Fed's tightening spree from 2022 and 2023. Higher rates, slower M2 growth, less money flowing through the system. All of this adds up and compounds over time. Then there's the fiscal policy reversal. After 2 years of spending like there was no tomorrow, running deficits around 6% to 6.5% of GDP, even while unemployment was only 4%, the federal government is now slamming on the brakes. The current Trump administration just proposed slashing non-defense discretionary spending by 32% for 2026. Folks, we're talking real cuts to programs like USAID, the Department of Education, and more. Now, that might be healthier in the long term financially, but in the short term, it's going to sting for people and sectors that rely on government cash flow and can have some real impacts. Now, meanwhile, we've got tariff uncertainty. It's still making businesses pretty skittish. Companies want to reshore, but they're holding back because, quite frankly, no one really knows what the rules are going to be 6 months from now. And heck, you could argue 6 minutes from now at times. So here's the bottom line. Are we in a recession right now? Probably not. Could we be headed for one in the next 12 months? Well, I got to tell you, I think the risks are definitely elevated, maybe right now 40 to 50%. Now's the time to be alert, but not alarmed, but just alert. So that means watch spending, maybe tighten your financial strategy, keep an eye on data, but don't let the headlines drive your decisions. And if you want help separating those signals from the noise, just give us a visit at hobartwealth.com. We've got strategies for real people dealing with real uncertainty in the real economy. Now, before you go, Tell me in the comments, do you think we're headed for a recession by year end, or do you think that the worst is behind us, or maybe a mix? I'd love to get your feedback in the comment section below. Your take is always interesting to me and always gets me thinking a little bit differently as well. Also, make sure that you like, subscribe, and turn on that bell that you see on YouTube so you never miss a beat from the Wealthologist Weekly. I'm Chris Hobart, and I will see you next time. I appreciate you tuning in. Have a great rest of your week.